Ladies and gentlemen, good day and welcome to the Axis Bank conference call to discuss the bank's financial results for the quarter ended 31st December 2023. Participation in this conference call is by invitation only. Axis Bank reserves the right to block access to any person to whom an invitation has not been sent. Unauthorized dissemination of the contents or the proceeding of the call is strictly prohibited, and prior explicit permission and written approval of Axis Bank is imperative. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of the briefing session. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. On behalf of Axis Bank, I once again welcome all the participants to the conference call. On the call we have Mr. Amitabh Chaudhry, MD and CEO, Mr. Rajiv Anand, Deputy Managing Director, and Mr. Puneet Sharma, CFO. I now hand the conference over to Mr. Amitabh Chaudhry, MD and CEO. Thank you, and over to you, sir.
Thank you, Nirav. Good evening and welcome everyone. Wish you all a very, very happy new year. We have on the call Rajiv Anand, the TMD, Puneet Sharma, CFO, and other members of the leadership team. Over the last few years, we have set Axis Bank on the course of a predictable and sustained high-performance path guided by our GPS strategy centered around our customers and our employees. The Indian economy continues its upward momentum in Q3 and remains a beacon of optimism globally. A mix of judicious and bold policy moves has placed India in a sweet spot which bodes well for the sector in the medium term. In Q3 Financial 24, we delivered strong operating performance led by robust sequential growth across loans and deposits. Let me briefly highlight them. The bank has delivered an ROE greater than 18% for the last 6 quarters, while maintaining a better credit profile as compared to the past, instilling confidence in its sustainability across economic cycles. The bank has organically net accreted 39 basis points of CET1 capital in 9 months financial year 24. On loan growth, all the 3 segments delivered strong sequential growth with retail, SME and corporate book, gross of IBPC sold, growing 5%, 4% and 3% quarter-on-quarter respectively. On deposits, we improved the quality of our granular franchise significantly, with our LCR outflow rates and CASA ratio being the best in class in the sector today, and our retail term deposits growth improving to 12-quarter high. On cards and payments, we saw strong traction in new card issuances, cards in force, and spends led by our strategic partnerships. On the merchant acquiring business too, we have now attained leadership position with terminal market share of close to 19% as of November 23, with widespread adoption of our innovative technology-based product offerings. On digital and technology, Open by Axis continues to be the highest rated mobile banking app with rating of 4.8 on Google Play Store. On the iOS App Store as well, Open by Axis rating has increased to 4.7 this quarter from 4.6 earlier. Neo, our cutting-edge digital product offering for corporate and SMEs, is deepening our transaction banking relationship amongst clients. Axis Bank has been recognized in the highest leadership category with score of 77 in the Indian Corporate Governance Scorecard, recently published by Institutional Investor Advisory Services, with evaluation framework built around globally expected G20 OECD principles. We have tried to be ahead of the curve towards building a bank for the future with deep investment of management time and resources in our chosen areas of distinctiveness, namely digital, Bharat banking and customer obsession. We stay focused on 3 core areas of execution of our GPS strategy, namely embedding a performance-driven culture, strengthening the core and building for the future. I will now discuss each one of these areas. There is visible improvement in the retail deposit growth and quality of our deposit franchise. The growth trajectory of our retail term deposits continue to improve with 17% year-on-year and 2% quarter-on-quarter growth on period-end basis and 15% year-on-year and 3% quarter-on-quarter on QAB basis. Our low-cost CASA share at 42% is among the best in the industry and has compounded at 14% for the last 3 years. In Q3, we added 100 branches, taking the overall branch additions to 349 for the 9 months financial year 24 period, which is among the highest in the industry. We have seen all-round growth across businesses, and we have market-leading growth in our focus segments. Within retail lending, we continue to drive balanced growth across the product portfolio. The retail disbursements in Q3 financial 24 were the highest ever for a non-financial year closing quarter, aided by improved consumer sentiments and strong festive demand. Domestic corporate loans, gross of IBPC sold, grew 23% year-on-year and 3% quarter-on-quarter, led by a healthy pickup across sectors. The disbursement pipeline for quarter 4 continues to be healthy. MSME segment continues to remain a key growth driver for the bank. The combined portfolio of mid-corporate, SMEs, and small businesses grew 30% year-on-year and 5% quarter-on-quarter, and now constitute 21% of the loan book, up 620 basis points in the last 3 years. On strengthening the core, on wholesale banking, we have replicated the success of our digital consumer bank app with Neo for corporates. We have been on this journey for 2 years, and we now have a validation for the strong product market fit based on how quickly our clients have embraced it. On transaction banking APIs, we continue to see strong interest from corporates across industry segments, with 3.7 times growth in corporate onboarding, along with 7 times growth in transactions and 4.8 times growth in throughput. Neo for Business, our mobile-first transaction banking platform tailored for SMEs, continues to scale up in terms of customer onboarding. We saw an increase of over 25% in digital usage amongst these customers with the introduction of business banking specific features. We have also rolled out Neo for Corporates, our internet banking proposition for large corporates, to all new customers. As far as building for the future is concerned, digital banking performance continues to remain strong. The Open by Axis balance sheet had a 48% increase in deposits and 86% increase in loans. We launched a new digital savings account proposition, Amaze, that provides customers attractive joining offers and spends-based rewards for a nominally monthly fee. We also launched and scaled new products, including FD for standalone credit card customers, US dollar FDs and gift city for NRI customers, new loan and insurance products on Open. Bank-wide programs to build distribution continue. Our bet on Bharat Banking is growing from strength to strength. The quarter 3 financial 24 disbursements in Bharat Bank were up 46% year-on-year. Rural advances are up 34% year-on-year, and deposits in Bharat branches are up 11%, thereby aiding the PSL and profitability metrics. We have expanded our multi-product distribution architecture of 2,420 branches, complemented by 63,500 CSC VLE network and 80 plus partners across the industry. Our digital co-lending platform is now live with 10 plus partners, and the volumes are growing 80% plus quarter on quarter. Sparsh, our customer obsession program, is helping improve relationship and transaction intensity with our customers. Over the last 21 months, NPS across 12 retail customer journeys has moved up to 141 over an index baseline of 100 as we listen to and act on the voice of our customers. NPS is now an important lead indicator for us to invest in areas that matter to our customers. Sparsh is a bank-wide priority. It is embedded in rituals and practices across all the 5250 plus branches, all our customer touch points, and in the conduct of every employee. On Citibank consumer business integration, the Citibank integration remains on track with acquired business portfolio metrics trending in line with the internal estimates. Deposits are stable, and there has been improvement in cross-sell and metrics across wealth, insurance, and retail assets. We expect to complete data migration and systems integration by the end of first half of financial year 25. In closing, the growth momentum in India continues to be strong. We have taken global headwinds and higher interest rates in our stride. Consumer sentiment remains healthy with improved capacity utilization across sectors for corporates. The factors are ideal for an uptick in private capex. We see this as an opportunity to differentiate and serve our customers better. All of us are building an all-weather institution that will stand the test of time. I will now request Puneet to take over. Puneet.
Thank you, Amitabh. Good evening, everyone. Our quarter 3 FY24 operating profit was rupees 9,141 crores, up 6% quarter on quarter. Our PAT was at 6,071 crores, up 4% quarter on quarter. Our consolidated ROE stood at 18.61%. Each of these operating metrics was aided by a balanced sequential deposit and loan growth of 5% and 4% respectively. Our 9-month FY24 PAT was 17,732 crores, up 16% YOY. Our consolidated 9-month ROE was 18.86%, up 82 basis points YOY. Moving to our healthy operating performance, our net interest income grew 9% YOY and 2% sequentially. Our net interest margin stood at 4.01% for the third quarter. Fee income grew 29% YOY and 4% quarter on quarter. Retail fees was up 36% YOY and 6% quarter on quarter. Granular fees is 93% of our total fee. Core operating revenue grew 14% year on year and 2% quarter on quarter. Operating profits grew 6% quarter on quarter. Consolidated ROA and ROE at 18.61 and 1.84 for the quarter. Subsidiaries contributed 54 basis points and 9 basis points respectively. Bank's total business grew 20% and 5% and 5% quarter on quarter. Advances grew 22% and 4% quarter on quarter, and MEB deposits grew 18% YOY and 5% quarter on quarter. Advances gross of IBPC were up 23% year on year and 4% quarter on quarter. Retail loans were up 27% year on year, 5% quarter on quarter. SME loans were up 26% year on year, 4% quarter on quarter. Corporate loans gross of IBPC sold were up 15% year on year, 3% on a quarter on quarter basis. Our rural loans grew 34% year on year and 7% quarter on quarter. Our small business banking loans grew 40% year on year and 6% quarter on quarter. Our mid-corporate book grew 30% YOY. Our small business banking plus SME plus mid-corporate mix stood at 1,98,553 crores, 21%, constituting 21% of our loans. This is up 620 basis points in the last 3 years. Just, you may recall that this is our high margin, high ROC businesses. Retail deposits have started gaining traction. Our CASA ratio is amongst the best in the industry today. On a month-end balance basis, retail deposits grew 17% YOY, 2% quarter on quarter. CASA grew 12% YOY with a CASA ratio of 42%. On a QAB basis, which is quarterly average balance basis, retail term deposits grew 15% YOY, 3% quarter on quarter, and total deposits grew 18% YOY and 4% sequentially. The QAB CASA grew 13% YOY and 1% on a quarter on quarter basis. Average LCR during Q3 FY24 was at 118%. Outflow rates for us have improved by 600 basis points over the last 2 years. We are well capitalized and have a self-sustaining capital structure. The overall capital adequacy ratio, including profits, stood at 16.63% with a CET1 ratio of 13.71%. We net on an organic basis accreted 39 basis points of CET1 in the 9 months FY24. Our COVID provisions of 5,012 crores not in our capital adequacy calculation provide an additional cushion of 43 basis points. We continue to maintain a strong position in the payments and digital banking space. 1.26 million credit cards were issued in quarter 3. Card spends were up 79% YOY and 13% sequentially. Axis Mobile and Axis Pay have 10 million non-Axis Bank customers. We have 100 plus digital partnerships across platforms and ecosystems. 18.8 million customers on WhatsApp banking. Our credit card safe market share is at 14%. Retail card spends overall grew 88% YOY and 13% sequentially. We've had a very strong and healthy asset quality performance on our balance sheet, demonstrated by declining slippages, gross NPAs, and credit costs. Our PCR is healthy at 78%. On an aggregated basis, our coverage ratio is 153%. Net slippage ratio is 0.5%, declined 43 basis points YOY and 9 basis points Q on Q. Our gross slippage ratio is 1.62%, declining 41 basis points YOY. Q3 FY24 net credit cost is 0.28%. It declined 14 basis points quarter on quarter and 37 basis points year on year. Our key domestic subsidiaries continue to deliver steady performance. 9 months FY24 profit for the subsidiaries is 1108 crores, up 17% YOY with a return on investment on domestic subsidiaries of 50%. Axis Finance 9 months PAT grew 25% YOY to 425 crores. Asset quality metrics have improved, and the ROE for Axis Finance is 16.4%. Axis AMC 9 months PAT stood at 297 crores. Axis Securities 9 month PAT grew 31% YOY to 198 crores. Axis Capital 9 month PAT stood at 108 crores, and the entity executed 71 investment banking deals in the 9 months. Thank you for your patience. We'd be happy to take questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. An operator will take your name and announce your turn in the question queue. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ritu Singh from CNBC TV18. Please go ahead.
Hi, thank you. Good evening. Just a quick question on the deposit.
Your audio is not
For the
coming
industry,
clear.
we've been hearing from your peers that there's a bit of a slowdown. They have to fight for share of low-cost deposits. You've reported a 5% sequential growth. If you could just detail for us, what sort of growth you're seeing, if this will sustain, and as deposit rates move up, will you be able to sustain your margins also at 4% kind of levels? And the second question was on the loan growth as well. 4% QOQ, but you recently highlighted to us that because deposit growth has been lagging, perhaps credit growth at some point may get impacted. So I just wanted to get an overall sense of what you make of the current environment and what sort of growth you expect in credit from here. Hello?
Ritu is just trying to ensure that we understand your question, and he's just repeating it. Can you just hold on for a second, please? Yeah.
Sure.
Ritu, your voice was not very clear. It was echoing, so it was very important for us to ensure we understood your questions. I think you have 3 questions. Please will answer them.
Thanks, Ritu. I think let me start with the net interest margin question first. Effectively, we've always maintained consistently through the last 9 months that margin should be looked at on a 12-month basis. Effectively, that's where we continue to comment on how margin trajectory would look like. Our structural guidance and margins moved up last year because of all of the improvements we've done in the franchise. We are currently on a 9-month basis operating at 28 basis points higher than our guided structural margin of 3.8, and on a standalone Q3 basis operating at 21 basis points higher than our structural margins. We do believe that we will continue to endeavor to maintain the cushion that we've built over our structural margins as we operate into the fourth quarter. That's how we would like to respond to your NIM question. I'll take your third question next, which is deposits growth and advances growth converging. Given the LDR trajectory that we have, I think, let me just flag off from a data point perspective. We are probably one of the few banks that actually saw our LDR moderate by about 114 basis points on a sequential quarter basis, which is a outcome of the strong deposit growth and advances growth. Overall, on the longer term, given the system liquidity is, we are of the view that loan growth will converge with deposits growth, and deposits growth will, in the longer term, in the short to medium term, will be a constraint on advances growth. I think your first question was a data point clarification. Yes, we are calling out the fact that we've delivered a 5% Q1Q deposit growth for quarter 3. I hope we've been able to answer all your questions as we speak.
Sorry, the question on deposit was
Ritu,
how...
sorry to interrupt you, but your audio is not clear. Can I request you to speak through the handset?
Yeah, I'm using the handset. The question on deposit rather was that, at a time when your peers are saying it's difficult to garner low-cost deposits, how have you been able to get this kind of growth? And, whether you see any pressure going ahead, that was all.
Ritu, we've been indicating that we've been on a journey to improve our liabilities franchise. with the quality of liabilities improving in the early part of the cycle and then the composition and growth coming through in the later part of the cycle, we had indicated that we were on a 11-12 quarter journey. We are in the 5th quarter of that journey. You're seeing early delivery on growth. Quality, we've already called out the improvement of 600 basis points on outflow rates that we've been able to improve. I think the deposit is trending as we thought it would, and I think it is business as usual for us as we stand today. There will be positives and negatives across quarters. We've had a good quarter, and that's where I'd like to leave that comment, please.
Thank you.
Thank you. Next question is from the line of Shayan Ghosh from Mint. Please go ahead.
Hi. Two questions. The first one is that, given RBI's actions on unsecured loans, they raise the risk weight. Do you plan to be more selective in the personal loan segment and, maybe tweak some of the risk filters? And the second question is, which sectors are you seeing corporate demand originate from? If you're seeing a pickup in the private capex. Thank you.
See, on personal loan, if you see our presentation, 80% of the customers are still existing to bank customers. That percentage hasn't changed. We've just tweaked minor onboarding criteria, but that's insignificant. The stress which has been in public news really is on loan ticket size below 50,000 rupees. We were not active in that segment. That portfolio is virtually nil for us. So we haven't had to make any changes, and we see the quality holding on as we've been growing this business.
Shayan, on private capex, this is Rajesh. Private capex, as I've been mentioning for the last few quarters, is quite broad-based. Auto, steel, cement, in FMCG as well. I think, because of the fact that corporate India has delevered over the last few years, their internal cash flows have been strong, and I think those internal cash flows have been going in to be able to support, private capex. Yes, some of that is flowing through to banks as well. The pipeline, even for us, continues to be quite robust at this point in time. I think it's fair to say that corporate India has been quite measured as far as announcements of private capex is concerned.
Right. Thank you, sir. Just one clarification in the first question. Did you say that you have made a small change to the way you selected those personal loans?
These are not related to the kind of news flow you see. These are internal process changes to get more efficient. Otherwise, if you see, as I said, existing to bank customers and our partnership business really contributes the bulk of the growth. And this is a segment which we have a lot of history on. So it is per se a safer segment. So there's nothing extraordinary we've done. It's business as usual. And the growth you see is a result of some transformation projects which we've been running over the years. We are midway through that journey. We expect the portfolio quality will hold up, and this kind of growth will continue. Thank you.
Thank you.
Thank you. Next question is from the line of Manojit Saha from Business Standard. Please go ahead.
Hear me? Hello? Hello?
Go
Yes,
ahead.
go ahead, Manojit.
So your personal loan growth is 28% at a time when RBI is making all these noises. I'm not talking about credit card is 93%, clearly the Citibank is, but are you planning to slow down your personal loan growth?
Hi, Manojit, this is Sumit here. So as I said in response to previous question, the growth you see is something which is continued from quarter 2 onwards. We have been running various transformation projects, and this is a result of some of those now fructifying. We are midway through that journey, And the growth is something which is not, we're not sacrificing quality for growth. Quality remains sacrosanct. 80% of the customers are existing to bank. Partnerships which we've been working on have been firing now. So all that continues to be good. If you see page 22, overall it also gives you a trend in terms of retail disbursement trends to overall disbursement in terms of unsecured, which continues to, which is slightly moderated actually. So it is at 22% versus 25% previous quarter.
Okay, okay. The other thing is that because of this risk weight increase, your capital depleted quite a bit. If you exclude the 9-month profit, then it's actually just above 12%. So any capital raising plans? And overall, all this loan growth, NII growth is not reflecting in the profit growth. What could be the reason?
Thank you for the question. My request to you is it's unfair to look at consumption for the year and not look at accretion for the year in the same breath. Therefore, you have to look at accretion and consumption on a cumulative basis. May I request you to see slide 16 of our investor presentation. We have very transparently called out the fact that we've accreted 177 basis points of capital in the first 9 months. And for growth and risk, we have consumed 138 basis points. So we've actually net added capital in a 9-month period of 39 basis points, all in CET1 terms. The risk weight circular is a one-time change, which has resulted in a charge of 70 basis points, and therefore our closing CET1 position is 13.71%. It is well above regulatory requirements. It's well above rating requirements for our domestic AAA rating, and hence we have no plans to raise capital at the current stage.
And the profitability part?
So my request to you is on your profit question, I would request you to look at the 9-month PAT growth. If you look at 9 months PAT, our 9 months PAT was 17,732 crores for the current financial year. It's up 16% on a year-on-year basis. Therefore, the way we need to look at this is on a 9-month to 9-month equivalent basis. All of this operational improvement has resulted in PAT growing by 16%.
So what was the exceptional item in Q3?
There is no exceptional item in Q3. Please recollect that on a single quarter basis, last year we were in an upcycle on interest rates where assets got repriced faster than liabilities. We have always indicated that liabilities will get repriced to the current financial year with maybe a slip into the first quarter of the next financial year. You are just seeing the income trend, which was asset repricing, play through in the same quarter last year, and liability repricing catch up in the current period. Hence, you're seeing a quarter-on-quarter, a year-on-year growth challenge for that given quarter. We've always maintained, please look at NIMs and profits on a full year basis. And on a full year basis, you're seeing a 16% growth. We have no exceptional items either in the current quarter from an expense or income standpoint.
Asset repricing is over, or you expect some more in the fourth quarter and going ahead? The deposit repricing, is it over?
We have always indicated that we expect deposit pricing to continue through the current financial year. The pace of increase of cost of deposits will reduce, and we have said that there would be a spillover into quarter one of the next financial year before base deposits start getting fully repriced. Marginal cost of funding has stabilized for the system, and that's how we expect deposit pricing to play through.
Correct. Thank you so much.
Thank you. Next question is from the line of Siddhi Naik from Reuters. Please go ahead.
Hi, sir. Firstly, one clarification. Because of the higher risk weights, you said that's impacted your capital adequacy by 70 basis points, if I'm not wrong?
That is correct. It has impacted my CET1 by 70 basis points.
Okay. So my second question was on the deposit growth. If you could throw some guidance on where you see, the deposit growth going forward, given that you say that deposit repricing is expected to continue.
Thanks for that question. If you have heard Puneet mention about the fact that over the short term and medium term, there will be a challenge on the deposit side. So in terms of what we expect is that this will play out the way we are expecting over the medium term. It will be a war for deposits, and in terms of the fact that we have a certain set of levers which are at play. Again, Puneet had talked about it. We had talked about the journey that we are in terms of the fact that we are in the fourth or the fifth quarter of those efforts and initiatives that are in play. And therefore, over a period of time, we do expect to participate with full might in this particular challenge of accreting deposits. And I think that's the way we are looking for the medium term.
Okay. So my last question is on your AIF investment. What's your total exposure to these investments, and what would your plan be? Would you look at selling this, or how do you perceive those investments?
Thank you for that question. Our total exposure to AIF investments is 207 crores, but it's also important for me to give you color. So the 207 crores is fully provided for. So that's our entire pool. Our entire pool is fully provided for. However, it's important to understand the color of the AIF pool given the quality of business that we have built. About 46% of these AIF investments that we have are either directly or indirectly sponsored by a government-owned entity or institutional entities like NIIF, NABARD, and NABFID. So that's the quality of the investments we carry in the NIIF. In addition to that, if we were to do a overlap of portfolio, 85% of overlapping loans are rated A- and above. Consequently, we do not believe that we will have a realized loss on this portfolio. The provisioning has been done in line with the RBI requirements because the 30-day period expired on January 18th. So full AIF is 208, fully provided for, and has been settled in the current quarter.
Okay, thanks.
Thank you. Next question is from the line of Rosebud Gonzalez from the Economics Times. Please go ahead.
Hi, so good evening. You mentioned about branch expansions. I wanted to know how important is branch expansion in order to get deposits? Hello?
So, the way we think about distribution is multi-pronged. Opening of branches, particularly in areas where we are underrepresented, and there's a whole lot of data that we do at a district level, look at our own market shares, look at the market share of our branches. So there is one piece which is sweating the existing franchise, but we will continue to open branches. Two is we have the world's highest rated mobile app in financial services, and that effectively sees something like 1.3 crore customers coming through every month, transacting 15 to 16 times. So that is a huge engagement tool for us and is also increasingly becoming a acquisition tool. And finally, we have among the largest partnerships, and we think of partnerships as a key differentiator for us within our distribution strategy. I'm sure you're aware that we have one of the largest credit card partnerships with Flipkart, and we have similar partnerships with Airtel, Google, and Amazon to name a few. And these partnerships bring us access to certain set of or certain cohort of customers who may or may not be banking with Axis. We are not only using the partnership route in places like Amazon and Google, but we have very strong partnerships in Bharat Banking as well, with CSC, Airtel Payment Bank, to name a few. So partnerships is core to everything that we do, within the bank, as we think of increasing the distribution footprint across the spectrum or geography that we have, semi-urban, rural, as well as metro and urban.
Right. Your Axis clearly has a lot of digital push, and so I'm wondering, why is there a need for physical expansion of branches also when everything is being digital right now?
I think it's like I said, I don't think we are in an either-or situation yet. What we are actually finding is that customers use. We are an omni-channel service provider, and what we find is that customers use each one of our channels for different needs. Yes, India is going more digital, but it is not as if we have stopped seeing footfalls at our ATMs. Yes, we are going digital and mobile, but that doesn't mean that customers are not using internet banking. Yes, we're going digital, but it is not as if customers don't come to our branches. They come to our branches for the more difficult, complicated transactions, or in many cases, just to have a cup of tea with our branch heads. So, our job is to be able to provide a omni-channel experience, which is in a sense seamless across each of the channels that I spoke about, and to be able to provide best-in-class services at each of the channels. So one of the things that we are certainly seeing, you heard Amitabh speak about Sparsh. We are seeing our NPS scores improve at each of our channels, and it is our aim to ensure that we continue to do so as we go forward.
Right. One more question. What percentage of your IT budget is allotted for cybersecurity?
We don't put that granularity out in the public domain. What we have commented previously is about 9% of our total operating expenses is for IT and tech.
Oh, okay. Also, what is your attrition rate overall and in the frontline sales stuff like?
Our attrition rates in the current financial year have actually trended down from our last reported number. We will report annual attrition rates as part of our publications, but what we can qualitatively tell you clearly is that attrition rates are trending lower from where we reported last year.
Okay. Thank you, sir. Thank you.
Thank you. Participants, due to paucity of time, please stick to one question per participant. The next question is from the line of Vishwanath Nair from NDTV Profit. Please go ahead.
Hi, sorry, I'm not sticking to this one question rule. I just wanted to ask the first point that I wanted to understand from you is the profit growth itself. 4%. I'm trying to understand why this is looking so low compared to your other income and your NII. I know I'm coming quite at the end of this call. But that's the first question. And the second one is with regard to your loan growth versus deposit growth. You said your LDR has come down. It's close to about 98%. How long can you continue with this kind of a deposit versus advances growth? Because at some point in time, this has to rationalize. When you say the two rates have to converge, I would assume that the lending growth also has to slow down a little bit.
Thank you for the question. Just from a housekeeping data point perspective, I think I heard you say Our credit deposit ratio, or LDR, was 98%. As we reported as of 31st December, it's actually 92.7%, so much lower than the number you indicated. Happy to work through the reconciliation with you if needed. I think the core question, that there are two separate parts to your questions. One is, why is profitability not tracking the growth in income, both interest and fee? If you would recollect, we had said that as long as the operating environment on the credit side remained benign, and we were able to deliver in and around our aspirational ROE of 18%, we would continue to invest in the franchise. That investment in the franchise is playing through the OPEX line. You would see that our OPEX on a year-on-year basis has grown by roughly about 32%. It's investment for the future, and we do believe that that's the right kind of investment to be making today to create a sustainable franchise. I think the second question that you had was around how do we see deposit growth and loan growth play through in the future. In our assessment, given where system LDRs are, including our own, we do believe in the short to medium term, deposit growth will be a constraining factor to advances growth rather than the other way around.
Thank you. We'll take the next question from the line of Ashish Agassi from PTI. Please go ahead.
So you mentioned about the war for deposits and difficulties around that. What has been the reliance on the non-retail part of the deposits during this reporting quarter? And as you say that it will be a constraining factor, would you have to also go in more for the bulk deposits going forward just to basically serve the loan demand?
See, I think the one thing I want to flag off is, please look at the quality of deposits that we have. Our outflow rates were about 21.5% last quarter. They're roughly about 21.5% this quarter. That should indicate to you that we have kept the mix of deposits reasonably healthy on a full balance sheet basis across the 2 quarters. We will obviously dial up or dial down a given segment of the deposit depending on our need. We really don't have a targeted number that we work with across relevant segments. Our granular retail term deposits have grown 17% year on year, which again is one of the strongest growths that we've had for the period. Like I said to the response to the previous question, we do believe systemically where system liquidity is, deposit growth will constrain advances growth. We are a large balance sheet. We will work through the components of deposit as we build our operating model through the subsequent quarters.
Okay, sir. And so with the CD ratio at 92.7, there have been reports of some concerns at the on the regulatory front with the high CD ratios. Has there been any communication received by the bank on that, or probably you are looking at getting down this number?
Thank you for the question. My understanding of the regulator stance that was made public a few days ago is the regulator views this as one of the many metrics that they would like banks to track. There is no prescription of that metric that the regulator is looking to prescribe. And I'm only taking this understanding from public comments that I've heard from the regulator. Effectively, if you look at our incremental LDR was 70%. Like I said, we focus on managing the balance sheet on multiple variables. Our LCR has remained flat quarter on quarter at 118%. We feel comfortable with the quality of the balance sheet we've built. And yes, deposit growth will constrain advances growth. But I think we should be able to work through that over the next few quarters.
Okay, so a final question, if I can squeeze in. So what is inhibiting corporates from making the investment announcements?
No, nothing is inhibiting, corporates. As I talk to our clients across large, mid, and even SME, the general outlook is quite bullish. I think the outlook of the fact that India could potentially grow at 6.5% into the foreseeable future, I think is well understood. There are enough pools of capital and liquidity that is available to support this across the capital structure, meaning that there's enough money from an equity perspective. Markets are buoyant. You've seen the IPO market being quite buoyant as well. There is global liquidity that is available. Maybe it's coming to you at a price. And most important, because of the fact that corporates have deleveraged, all the cash flow that they're generating, which used to go to pay down debt, is now actually is sitting on balance sheet. So the way to think about this is that the future looks very bright. There is ample scope from a banking perspective to be able to support private capex as and when it comes up. And two, because of corporate balance sheets being so delevered, there is ample headroom for them to grow as well. So I'm quite positive about the future of private capex in this country.
Thank you. Ashish, I'll request to come back for a follow-up. Participants, please stick to one question per participant. The next question is from the line of Jineet Parmar from Money Control. Please go ahead.
Thanks. I just wanted to understand, Puneet mentioned there's some constraint on deposit growth. I'm sorry if I missed some points you mentioned, but if you could highlight as to what challenges or constraints you're looking at.
Thank you for the question. I think we said that the constraint is not operating or specific to Axis Bank. We believe the current liquidity environment that prevails would be a constraining factor on deposit growth for the banking system as a whole, of which we are a meaningful part. And consequently, the comment that deposit growth will constrain advances growth. That's what we had indicated as part of an earlier response, please.
Thank you. Jineet, I'll request to come back for a follow-up question. Next question is from the line of Ekta Suri from Z Business. Please go ahead.
Am I audible?
Yes, ma'am.
मेरा सवाल एक्सेस कैपिटल को लेकर होगा, जिसकी अंडरराइटिंग प्रैक्टिसेस को लेकर बहुत से सवाल उठाए जा रहे हैं, क्योंकि अभी हाल ही में हमने देखा कि एक्सेस कैपिटल ने 260 करोड़ रुपए की पूरी गारंटी दी। तो उस केस में आज जिस कंपनी के लिए गारंटी दी उसका प्रमोटर जेल में है, कंपनी की हालात ठीक नहीं है। तो मेरा सवाल अंडरराइटिंग प्रैक्टिसेस जो क्वेश्चनेबल हो रही है उसको लेकर है, उस पर क्या कमेंट देंगे सर आप?
मैम, पहली बात तो आप एक सिंपल सी खबर को सनसनीखेज ना कीजिए। आप कह रही हैं सनसनीखेज खबर है और हमारी अंडरराइटिंग प्रैक्टिसेस पे क्वेश्चनिंग है। जो भी हम ट्रांजैक्शन करते हैं सोच समझ के करते हैं। जो भी ट्रांजैक्शन जो आप रेफर टू कर रही हैं, हम लोग इस तरह की कॉल में उस पर कमेंट नहीं करना चाहेंगे, बट मैं आपको एश्योर करना चाहूँगा कि हमारी अंडरराइटिंग प्रैक्टिसेस बैंक से लेके हर सब्सिडरी में उसका एक प्रोसेस है, उसके प्रोसेस के थ्रू गुजरती है। कल कोई अरेस्ट होगा नहीं होगा ना तो उसका आप प्रेडिक्शन कर सकती ना मैं, बट हाँ उस अंडरराइटिंग प्रैक्टिस के बेसिस पे हमें बहुत हाई कॉन्फिडेंस है कि हमें जहाँ तक एक्सेस कैपिटल का सवाल है या बैंक का सवाल है, हमें कोई नुकसान नहीं उठाना पड़ेगा। इस पर जो हमें कवर अवेलेबल है वो मेनी टाइम्स ओवर है। जो बिजनेस है, जो अंडरलाइंग बिजनेस है, वो इंडिया का वन ऑफ दी ओनली टेलीफोन मैन्युफैक्चरिंग, मोबाइल फोन मैन्युफैक्चरिंग बिजनेस है जो काफ़ी अच्छा कर रहा है, जिसकी अच्छी खासी बिड्डा है। तो आप इसको प्लीज़, मेरी आपसे रिक्वेस्ट ये है कि अगर आप और समझना चाहें तो हमसे सेपरेटली बात कर सकती हैं, बट किसी एक रिपोर्टिंग के बेसिस पे आप ये ना बोलिए कि हमारी पूरी अंडरराइटिंग प्रैक्टिसेस ही गलत है। वो गलत होगा और वो सही नहीं होगा। थैंक यू।
तो सर अभी जैसा आपने बोला कि एक बड़ी कंपनी के लिए आपने ये अंडरराइटिंग प्रैक्टिस रखी थी, तो अब उसका आईपीओ
मैंने कुछ नहीं बोला, मैंने ये नहीं बोला मैंने बोला ये कि मैं आपको एक स्पेसिफिक ट्रांजैक्शन में कमेंट करना नहीं चाहता, आपको कुछ भी रेफर करना है प्लीज सेपरेटली आके बात कर लीजिए। ये इस कॉल में स्पेसिफिक ट्रांजैक्शन हम डिस्कस नहीं करना चाहेंगे। थैंक यू।
Thank you, Ekta. I'll request to come back for a follow-up question. Next question is from the line of Anmol from ED BFSI. Please go ahead.
Hi, thank you. I think we have got enough meat specifically on the deposit side. But just quickly, is there any average that you want to put in? Because 118%. Why I'm asking you these questions, sir, is because your CASA ratio is and deposit ratio is absolutely best in the industry, is what we have learned. So, what is your outlook specifically in deposit in terms of the CDR ratio? That is one. And more importantly, sir, I would also like you to give us a broad view on the digital, because we have seen huge investments going on in digital from every bank, including yours. We have seen great initiative in the open. So, how many customers are being acquired through mobile app, and how are they coming into the banking system? Are they new customers? Whether they are actually adding to the business growth of yours, whether they are accessing loans? If you could give some perspective on digital, would be really great. Thank you so much, sir. This is Amol here.
So on the first question, I think you spoke about LCR and the fact that currently we are at 118%.
Yes, exactly.
Our guidance has always been that our LCR, and Puneet spoke about the fact that outflow rates, i.e. the quality of deposits, has significantly improved over the last 3 years or so. Our LCR rates typically will bob between 115 to 120%, and if you look at our track record over the last many quarters, you will find that we think that is the optimal number for us. Too much, has negative implications. Too little has liquidity implications. But we are quite comfortable, keeping this number between 115 to 120. Puneet also spoke about the fact that we are in a liquidity constrained environment. RBI has kept liquidity tight, for various reasons. We are really hoping that the situation will improve as we go forward. But this is the situation that we are in. In this situation, as you have seen, we've been quite successful in raising deposits across the spectrum. We deal with customers in the retail space. We deal with customers in the corporate space. We deal with customers in the government space, and each one of them has pools of savings which we want a share of, and that's really how we think about our deposit franchise as well. Coming to the digital side, I think digital is in a sense core to everything that we do. Our mobile app with a Google Play Store rating of 4.8, which is the highest globally among banking and financial services entities, is well known. It's a journey that we began many years ago, and we continue to build on capabilities here, adding to some of the data architecture that is building out in India. Account aggregator being a case in point. We are among the leading players on the account aggregator side as well. What that does effectively is, so far we've really thought about Open, our mobile banking platform, as a platform for existing customers, but increasingly we are beginning to think about Open as an app for all Indians. So which means that whether you're a customer of Axis Bank or not, you will be able to utilize the world-beating capabilities of the mobile banking app. We've been able to embark on a similar journey on the corporate side as well, through Neo, where we have built a library of APIs to build for customer journeys in trade finance, cash management, and FX to start with. The traction on this has been very good. We've also built an app for our SME customers, which is in a sense beyond banking, and we're seeing very good traction within that space as well. The focus really on Neo is to deepen relationship with the existing clients, for us to get new clients, such that we're able to get disproportionate market share of transaction banking which in turn will hopefully convert into better current account balances for us as well.
Thank you. We'll take the next question from the line of Anshika Kyasta from the Hindu Business Line. Please go ahead.
Yes, sir. Good evening. Wanted to check one thing. Most of your peers have reported some amount of moderation in slippages, but your gross slippages have been consistent both on year and slight increase on quarter. Could you please elaborate on where these slippages are originating and some guidance on how do you see the slippage trend?
Thank you for the question. I think we need to look at both gross and net slippages in conjunction. Our gross slippages for the quarter were 1.62%. They declined 41 basis points YOY. So there is a year-on-year decline in gross slippages, not an increase on a year-on-year basis. Yes, they have increased on a sequential quarter basis, which is Q3 higher than Q2. Please appreciate that quarter 1 and quarter 3 are seasonal billings for the agricultural portfolio, and that's where we see a blip up, which is in the normal course of our business. So X of the rural portfolio that is subjected to this seasonality, our slippages have been trending in the right direction. If you look at our net slippages number, our net slippages number for the quarter was 0.5%. It declined 43 basis points on a year-on-year basis and 9 basis points on a Q-on-Q basis. You'll be able to see details of that on slide 60 of our investor presentation, which gives you a reasonable time series that indicates the moderation both on slippages as well as the improvement in the asset quality reflected by meaningful reductions in gross and net NPA over the last 4 to 5 quarters.
Thank you. Next question is from the line of Sachin Kumar from Financial Express. Please go ahead.
I wanted one clarification. You mentioned that operating expenses, it's increasing 32%. So, is it one of the main factors which has dragged down, which has been, it has slowed down your profit growth, net profit growth in Q3?
Like I said, I think the operating philosophy that we have is as long as we can deliver in and around the 18% ROE metric, we'd like to continue to invest in the business. We are investing for the future. You heard Rajiv through the previous conversation and some of my other colleagues talk about the significant investments we are making in digital and tech and growing our franchise. We've done about 350 branches in the last 9 months. We think the environment, the benign credit environment accords us the opportunity to continue to invest in the business, and that's what we will continue to do. When the environment changes, we do believe that we have the capability of reining in costs when we need to. So yes, you're seeing investment flow through OPEX in the current quarter.
Thank you. Ladies and gentlemen, we'll take that as the last question. I will now hand the conference over to Mr. Puneet Sharma for closing comments.
Thank you, Nirav. Thank you, ladies and gentlemen, for taking time this evening to speak with us. If there are any questions that you have that remain unanswered, please feel free to reach out to our corporate communications team. We'd be very happy to address them. Thank you and have a good evening.
Thank you very much. On behalf of Axis Bank, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.